Thursday finally brings the long-awaited jobs report for September. We may not necessarily see one for October at all, but it does provide the basis for expectations around the December rate decision from the Federal Reserve. So let's look into the numbers, what the markets are expecting, and what could happen in terms of knock-on implications for the US dollar, for the likes of the Nasdaq, and for gold. Here we are. So this is the market expectations as things stand for Thursday's jobs report. 50K on the payrolls, roughly double the number seen in August. Unemployment remains at 4.3, average hourly earnings dropping down to 0.2 for the month, but the year-on-year remaining steady at 3.7. And by and large, if we're looking here, that the expectation here is that we see weakness in terms of government payrolls, of course, and then weakness in terms of the likes of the manufacturing payrolls, but not to the same degree that we saw last time. So a notable uptick on that front and a little bit of an increase in terms of the private payrolls as well. Now, in terms of the outlook for the next meeting from the Federal Reserve, this is the backdrop coming into this. And of course, the view from myself is that part of this is going to be impacted by market sentiment coming into it as well. If we see the weakness seen in equity markets at the moment continue, it's a possibility that we see the Federal Reserve feeling the need to step in from a market perspective and not only from an economic perspective. Of course, the economic side of things is certainly the mainstay of the Fed, and we have seen other data points which do provide the basis for them to act. Of course, we're thinking about the Challenger job cuts number, which rose to, I think, 153,000, absolutely massive spike in terms of job cuts. And then we've seen the ADP payrolls number that has increased, but still relatively low by historical standards. In terms of market expectations for this December meeting, it's roughly at 50-50 now. Remember, less than a month ago, that number was over 90%. So markets have gone from being very confident of a rate cut in December to thinking it's a coin toss, essentially. In terms of the dual mandate from the Federal Reserve, it remains to be the case that they need to get inflation under control and make sure that there's full employment, or essentially unemployment at sort of the kind of lows that we have been seeing of late, quite frankly. It's not like we're looking for a 0% unemployment rate, but if we see it moving towards the upside in a meaningful manner, it's the kind of thing that the Federal Reserve feel the need to step in to arrest that move. In terms of the ADP numbers, of course, they continue to be released despite the shutdown, and so we can use that as the basis for what to expect here from the payrolls numbers. Now, historically, people have always said the ADP numbers aren't particularly useful as a gauge for how the jobs report, the proper jobs report, essentially will come out. And essentially, when we're looking here, it's notable that this is the eventual final figures for the jobs report for the payrolls. And you can see that by and large, over recent months, there has been a relatively close correlation in terms of these numbers, the sort of misses that we've been seeing, roughly 25K above or below. That's the maximum that we've been seeing over the past 4 months worth of data. So this time around, markets are expecting an increase in terms of the payrolls number. In actual fact, you can see here that the September figure for the ADP number was a decrease, so a negative reading. So does that mean there's a possibility that we could see this underperform in terms of the figure on Thursday? That's a possibility, but also it's worthwhile noting that this correlation, the closer correlation, is between the final payrolls number and the ADP number, not the initial payrolls number and the ADP. And therefore, ultimately, you could see a downward revision to that figure to bring it closer to the ADP number, which is generally what has happened in the past. So when you see the ADP figure and then the Friday number comes out, you say, oh, they're not related at all. But once you see the revision to the Friday number down the line, then suddenly you start to think, well, actually, it was closer between the two than it might have appeared in the first place. This is a breakdown in terms of where the jobs are being created. What we have seen over recent months is more and more of these categories coming into negative territory. It really tells you a story about the US economy right now, being propped up by the education and health services sector, then some construction over the past month, but that's not necessarily been a constant, and a little bit of the other services side of things. Negative in terms of government, as you can see there in the light pink at the bottom, and that's something that we've seen quite a bit over the past 4 months, and that's very notable because what we saw under Joe Biden is a break from the norm, which is essentially normally you see a deterioration in terms of the percentage of total hiring going into government jobs during periods of economic strength. When you see economic crises, generally you see a rise in terms of the percentage or ratio of government jobs to all jobs being created, because of course there's increased stimulus, there's increased money being pushed into the creation of jobs through the government sector. And then when the economy is running hot, you don't necessarily need to see that kind of thing, and you see private businesses instead ramping up hiring. Well, what we've been seeing here is a sort of rolling over as Donald Trump's come into power. Of course, now recently we've had the government shutdown. There've been question marks on whether that's going to lead to a raft of job losses in many of these different departments. Some of them have been reinstated, so I don't necessarily think that will be the case. But certainly it does allude to some potential volatility over the near term. And of course, when people are not getting paid, they're not necessarily spending. And so businesses might have held off on hiring during this period, because if they were highly reliant on sales to people that are working within the government or government entities, they wouldn't necessarily be able to rely on it in that period, because their spending patterns will have shifted as a result. So going forward, it's likely that the government sector is likely to provide a drag on the payrolls numbers. In terms of the average hourly earnings numbers, we utilize it as a proxy for inflation. So if we saw a sudden surge in terms of wage growth, it means that perhaps the fears within the Federal Reserve are justified and there's a need for them to cool off in terms of rate cuts. Well, in actual fact, the 3-month annualized wage growth figure on the bottom there, you can see is sort of back into pre-pandemic areas. So I don't necessarily think that's a massive problem. And by and large, market expectations for this report signal a relative stability in terms of wage growth going forward. In terms of the market impacts and how things are trading at the moment, undoubtedly, the Nasdaq's really the big ticket story at the moment, because really we're seeing major downside around the tech sector. Once again, and I record this on Tuesday, we're seeing the Nasdaq being hit heavily. So really there's significant fears around this AI bubble popping, and that's not going away for the time being. It might go away after Nvidia earnings, which is after the close on Wednesday. Of course, that's prior to the jobs report. So this will be a key one to watch. But we've now broken through trendline support. We've broken through the 76.4 fib support as well. So really the last bastion that needs to hold is 23981. If we break through that level, it points towards a wider pullback coming into play following a historic run up into record highs and up through 26,000. So yes, we've broken through a couple of really key levels of late, and we need to start seeing this bottom out. But I think 23,981 is really going to be the key level to watch out for. In terms of the precious metal space, this has also been a bit of a tough time for those that think that gold essentially just keeps going up and up and up, because it's not done that, because we essentially topped out just below 4,400. We dropped down to 3,900, a massive swing. But of course, it came off the back of a period where we've gone from 3,300 up to 4,400. So in the grand scheme of things, it's just a consolidation period after a massive run up. Could be similar to what we saw back in April times. So April through into September, essentially, we saw that pullback, and then we just traded in a consolidation period before we rallied upwards once again. The long-term trend is undoubtedly bullish, and it remains so. So from my perspective, I think there's a good chance that we see a similar kind of thing coming into the fore. I don't necessarily think that we're suddenly just going to surge into record highs right away. I do believe in the long-term narrative that means that gold should continue to perform well. But I am very aware of the fact that when you run that high, at some point you're likely to see a pullback. And when that pullback comes, you're potentially going to take a little bit of time to gather momentum and start to surge higher once again. This recent pullback has come back into this trendline support alongside the 76.4 fib. We've started to regain ground from that level. I would say if we're looking over the intraday basis, I've got some fears of this potentially being a retracement once again, which means a rise through 4111 would certainly give me greater confidence that we've sort of based out for the time being and started to rise back towards the upper echelons of this recent area. But there's certainly, unless we start breaking up through this 42.45 level, there's certainly some question marks about whether we're going to see a sort of ABC style retracement into a deeper move, or whether we just come into consolidation, the same kind of thing that we've seen here. As we can see here, that we did actually see that ABC style retracement. So have we seen it ABC? Maybe that C leg's yet to come. But certainly as things stand, that C leg isn't necessarily lower. We're holding up at the support level, and certainly coming into this jobs report, if we see further weakness on the jobs front, I think the 50-50 perception in terms of a rate cut might be a little bit cautious, because with the weakness we're seeing in terms of the economy right now, alongside the weakness we're seeing in terms of the jobs market, I think it's a good chance that we do see the need for the Fed to act. And certainly if we see a weak jobs report, then that should play into that story. In terms of euro dollar, let's just quickly look at things. So this is the daily time frame. From a weekly time frame, you can see here that we've seen this really strong run up and now starting to really sort of stutter quite significantly. You can see from a wider perspective, we do have this descending pattern of the highs in play here. So let's just try and clip that top end there. So, we're in that kind of area. I mean, look, you could possibly sort of take that down to the prior high there, and then you've got it clipped here. So we're certainly in the kind of area that could potentially see this market start to turn around. Fib's not useful. So really, let's just get guided by what's happening in terms of price action. So notable here that, let me just pull this onto full screen. Notable here that we've not only sort of stuttered in terms of creating new highs, which we have created, but very sort of slight new high, and then ultimately we're faded immediately. But we're now coming back towards that swing low that we have around here, which is 1139. Certainly over the intraday charts, you can see here starting to fade once again following a rally, an attempt to try and break through the price swing high. That's not happened. And now we're turning lower once again. Let's look at this from a fib perspective, coming into the deep fib zone there. So starting to fade. I wouldn't be surprised to see some dollar strength coming into the fore here, following a recent rebound here for euro dollar. So it's going to be an interesting one to follow. But this does, to me, start to look like the rally and the run up that we've seen in terms of euro dollar as Donald Trump's come into the White House, could start to reverse in a meaningful manner. If we see the Fed take a more proactive approach and start to lay out plans to cut rates in a more dramatic fashion, that could potentially start to turn the tide on things in a more significant way. But at the moment, the US dollar looks like it could start to see a little bit of a fight back, particularly if we break through the 1139 level for euro dollar. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.